Yeah, I mean, it does. I do want to touch on a few different points. I agree with you. If I had $1 billion and I had to pick one asset to buy, I would buy Bitcoin. I agree with that. I mean, in terms of everything else you mentioned, there's no fixed supply. I've heard your discussion before about why it's thermodynamically sound, obeying the laws of thermodynamics with Bitcoin. But I guess my question for you is, yes, if you only could buy one thing with Bitcoin, or if you could only buy one thing for $1 billion, it would be Bitcoin. But we're not constrained to only buy that one thing. And I'm sure you have, well, I guess I don't know. I'm guessing in your portfolio you have more than just Bitcoin. Maybe not your crypto portfolio, but I imagine you have exposure to other assets as well. I mean, I know you've done very well investing in equities in the past. How do you manage that, some type of portfolio theory? How do you figure out, what sort of allocation you want towards Bitcoin and or stocks? Now, I would agree with you 100 years ago, if you had bought any business, yeah, I mean, there's a good chance they're not around anymore. But I mean, today you don't have to buy a single business. You could just go buy an index fund or a mutual fund. You're still doing relatively well. And I know the general idea is you can take a loan for 2.5%, and as long as your annual returns are easily beating those, there's no reason not to do it. But I'm also curious. Is there? Sorry, I'm hearing a little bit of an echo. Is there a level of volatility that is okay? So we know with like the S&P 500, there's going to be some volatility, but we know that annually you expect to do pretty well over the long haul, and that's why you could argue taking out a loan could make sense as long as you have the income to make the loan payments. You're applying the same thing to Bitcoin, which has better returns than the S&P 500 annualized. But Ethereum has great returns too. So I guess my question is, are there ways when you look at what you want in your portfolio, are there certain volatility restrictions that you would imply or that you would have to have before you would say, okay, it's worth the risk? And furthermore, how do you sort of figure out what allocation to put towards each asset? Because again, yeah, like if you could only pick one asset, it might be just $1 billion to Bitcoin, but you don't have to just pick one. So how do you figure out how you split that up among various assets?
I think if you want to construct a portfolio, you have to start, let me just start with one observation. This whole idea of, the right thing to do is have a diversified portfolio is in and of itself just a prejudicial bias. It's like, it's not even true sometimes. It would be true under certain circumstances, but just allowing people to put that in your head is ridiculous. For example, it might turn, if I knew that everything was going to zero except for one thing, if I knew that, right, then it doesn't make sense to have a diversified portfolio. And you have to actually think more deeply about the macroeconomics here. And the macroeconomics and the political and the social economic dynamics would determine what is your state space of potential choices. You're on the Titanic is sinking, you're going to die, and there's one lifeboat, and you've got 10 people in your family. Okay, do you actually put one person in the lifeboat and the other 9 stay on the Titanic? Or do you all get on the lifeboat? Because you're going to die if you stay on the Titanic. Everything is sinking, right? I mean, you're on an airplane and we blow out the window and oxygen is coming out of the cabin, an oxygen mask drop down from above. Does everybody put on the oxygen mask, or does just one person or 2 people or 10% of the people put on the oxygen mask? If you're in a life or death situation, portfolio theory is ridiculous. And if you're in an engineering situation, if you're building a building and you have a portfolio of clay and bricks and aluminum and brass and copper and steel, and you can choose anything to build the building with, diversifying and using some clay and some copper and some steel is not the right answer. there is a right answer under an engineering constraint. You build a plane in aluminum, you build a building with steel. When we didn't have steel, we had iron, and before iron, we had masonry, and the buildings were 6 floors high. And when there's a new technology which is better, it completely invalidates the previous science. So let's look at portfolio theory. Well, you know, there's a lot of arrogant presumption in portfolio theory. Like, if I put you, let's take this example. If you were in Lebanon and the pound is 1,500 pound to the dollar, and if I were to tell you that the currency is going to crash, you're going to lose 85% of your value in every locally denominated currency and currency derivative. And your choice is a market basket of Lebanese stocks, Lebanese real estate, Lebanese currency, Lebanese bonds, you know, or Lebanese savings accounts, or the US dollar. So what's your portfolio theory tell you? Like, tell me what your diversification strategy is. Should you diversify? Because every single thing other than the dollar is going to go to minus 80% next week. No diversification makes sense. They're all correlated to the currency. And so you think you're diversified, but the real question is, like, let me put you in a different situation. You're in Germany, right? And the Nazis are about to take over, or you're in Germany and they're about to lose the war. Okay, tell me what your diversification strategy is across all German real estate, bonds, stocks, or whatever. If the government fails, or if you're Jewish and you're about to get thrown into a concentration camp, the overarching issue is everything you can invest in is correlated to the political situation. In Russia, you know, when the communists take over, they're going to seize all the private property. So having a diversified portfolio strategy of properties that are about to be seized by the government is a waste of your effort. So the real question is this portfolio of things correlated? Because most of these things, like for example, today, every stock is a currency derivative. Every stock is valued based upon the expected cash flows of mostly US dollars and to a smaller extent euros. And every bond is a currency derivative. And and all the derivatives are currency derivatives. And all the commercial real estate is a currency derivative. And all the ETFs are currency derivatives. So, and all the currency obviously is currency derivatives. So 90% of what people think they're diversifying into is all correlated to the US dollar. And the US dollar was devalued by something on the range of 30 to 40% in the last 12 months. If we look at performance over the last 12 months, S&P is up 39%. The S&P generally is up 10% a year for 100 years. So 39% means a 29% collapse. Plus, the dollar was already being devalued at 7% a year. So you could say that backing out the risk premium of holding the stocks, which is traditionally 3% a year, you had a 36% devaluation of the US dollar in the past 12 months. Which meant that was a 36% devaluation of all value stocks, all cash, all bonds. If you're holding a bond that's yielding 4%, you've got a negative real yield of minus 34% in 1 year. So to be extreme, what's your diversification strategy if you're holding Argentine equity and debt and real estate? Because the inflation rate there is 85% informally right now. So when you say, should we diversify? The answer is, let's come back to Lebanon. The only answer is you had to convert to dollars, but that didn't work either because they seized all the dollars in the banks. Like they froze all the accounts. So it only works if you diversify to a hard asset and then you get it out of the political jurisdiction where it might be impaired. So we come back to your question, like, how do I view the world today? I think that the first issue is the currency is being devalued everywhere in the world. It's being devalued at the rate of 20% or more, at least in the US. Every other currency is pegged to the US currency. If the U.S. currency actually just collapsed 37%, which is what the S&P index is pointing to, that means the euro collapsed 37% against scarce assets. That means the Chinese yuan collapsed, the CNY collapsed 37% because it's pegged. That means that the Saudi currency, the Emirati currency, the Swiss currency, the Singaporean currency, every first world pegged currency collapsed 37% against scarce assets. Second and developing world collapsed 20% more, and the third tranche, the weak currencies, Zimbabwe, Venezuela, even Argentina, Syria, Iran, Lebanon, they're collapsing 80% against scarce assets. So now you got to ask the question: what if I don't want to own 100% Bitcoin? Mm-hmm. But by the way, it's like people think it's risky to own Bitcoin because it's volatile. That's basically myopic thinking, because what you're doing is you're putting blinders on and you're fixating upon the volatility of Bitcoin instead of looking out. How much did the volatility of Bitcoin hurt you if you own Bitcoin in Lebanon? Because they devalued the currency 90% and they seized and froze all the foreign assets. So you lost 90 to 100% of everything in 12 months. Okay, so the volatility of Bitcoin, which is up 280% in US dollars and going back and forth, is, a friend of mine says, when there's blood on your collar, your dry cleaning is the least of your concerns. Mm-hmm. That volatility is second or third order. If the airplane is depressurizing, you're worried about the hygienic standards of the oxygen mask, who gives a crap? You're going to be dead in 60 seconds, right? When the ship is sinking and you're worried about whether you got the best seat on the lifeboat or try to figure out whether you wanted this one or that one, you're going to be dead in 2 hours. So if you have if you're Jewish in Germany in 1932, the only answer is you needed to leave. That's the only answer. There was no other answer. It was just going to get progressively worse. And you're screwing around debating whether you should take a 25% haircut to sell you. Everybody, if you read the history, first they sold their property for a 40% discount, then a 50%, then a 60%, then an 80%, then a 90%, then a 95%. Then they lost everything. Then they had to pay a ransom to get out. And if you were lucky and you paid, a huge amount of money, that came from somewhere else, you might have got out. That's what happens when you have a collapse in a socioeconomic system. So the summary is there's no diversification strategy that works in Venezuela, Benjamin. None. There's nothing that works other than you got to go orthogonal to the monetary system.